Welcome back. Earlier today, the Kansas City Fed Labor Market Conditions Indicator was reported. We also have the Fed's Beige Book and the Fed speaker that spoke today, and that also has some pretty interesting implications. First off, LMCI, which is a labor market conditions indicator, measures the labor market conditions. It's based on 24 different variables. A positive value indicates a labor market is above the long-term average, while a negative number signifies that's below the average. So positive number is a good thing. Here we see the gray background histogram chart. That's the labor market conditions activity indicator. The red line is the S&P 500. Going back to 2019, we had levels around zero point 0.7, zero point 0.8, all the way up to a little over zero point 0.1, and the S&P 500, except for a couple glitches here and there, did experience a very nice trend to the upside. Of course, all that was taken away with the COVID stock market crash. That's when this labor market indicator dipped to the downside, but then recovered. What's interesting is that there is a pretty strong positive correlation. Interesting enough, it did not fall down when the stock market returned to the downside. But now that stocks are strong, it looks like this is starting to waver. We're at the lowest levels. I believe today's number was around 0.82. It's the lowest level we've seen in actually quite a while, going back to probably 2018. Here is the Kansas City Fed labor market conditions indicator against the Fed funds. Now, of course, higher interest rates always put a strain on the labor market. And we can see when we had numbers on this indicator around zero point 0.8 to 1, 1.1, we see that federal funds were around 2.5, 2.25, 2.5% Fed funds. However, and then obviously following this very brief but very dramatic stock market crash March of 2020. Now we see Fed funds at the 550 level. Now, the current level again on the Kansas City labor market conditions indicators on zero point 0.8. But given the fact that interest rates are more than double from where they were in 2019, logic would dictate we would tend to see this labor market indicator lower. The direction is to the downside. It's a positive number today, but over time it has tended to trend to the downside, and that's not a good thing. Now, here's the labor market conditions indicator against the 1 and 10-year Treasury bond. The 1-year bonds in white, 10 in red. Now, interesting that when labor market conditions were better, we had a very narrow inverted yield curve. The inverted yield curve occurred when the 1 is above the 10. But the more dramatic of the inversion, see the difference, the spread between the 1 and the 10? This coincides with weaker labor market conditions. We talk a lot about the inverted bond market, and it's not just a phenomenon that happens in terms of prices. It reflects um, something that's not good within the economy, and that affects the labor market. I mean, the fact of the matter is that the bond market reflects investment activity. And what's happening is that traders are not buying the short-term bonds. That's why the yields go up. When bond prices go down, yields go up. Well, the short-term bonds, like the 1 year over year to 550, this tells us that traders are not buying the short-term bond. They don't want to take the risk on the short-term, short-term, near-term future. Long-term, probably more optimistic. But the fact of the matter is, if they're not willing to buy the short-term bonds, think of it from an investment point of view. Are we going to invest in a new company? Are we going to open a new manufacturing plant? Well, we would take our cue from the bond market, and it's telling us not now. Things don't look good. The Beige Book was also released today. What it does is it compiles anecdotal evidence across the Fed's 12 different bank districts. And it's used very much so in deciding interest rates. It's a very important factor in the Fed's decision to raise interest rates. Now, the Beige Book today stated that businesses in several districts struggled during August to pass the costs to consumers. They said as costs of making goods are growing faster than prices. What does this mean? The cost of making goods, that's the wholesale level, that's PPI, Producer Price Index. It's faster than the prices that we pay, consumer price index. Well, the PPI minus the CPI is the red line. The white line is the S&P 500. If you take the cost at the wholesale level, a factory will go out there, they'll buy raw materials. The prices they pay, the inflation that they pay for those raw materials, that's reflected in PPI. It's thought that the factory, if they have to spend more on their raw materials, they're going to pass those extra costs on to the consumer, which we pay as CPI. But what's happening now is that the Fed's Beige Book stated that they're having a problem. Interesting with the language, too. They said that they struggled to pass the costs on to the consumers. What does that mean? It means that the factories and manufacturers have to pay higher prices if they want to buy these raw materials and stay in business, but they're struggling to pass the costs on to the consumer. They can't raise prices because they sense that the consumer just won't tolerate or cannot tolerate the higher prices. So what happens if we're running a business and we have to pay more for the raw materials, but our customers can't afford higher prices? Well, we eat the middle. So we have to pay more, but we can't pass on the extra costs. That's what the Beige Book is talking about. The red line here is PPI minus CPI. When the PPI minus CPI goes down, it means the costs for the wholesalers is going down more than the consumer. With the latest inflationary report, and that's what the Beige Book is talking about, this little blip here. This little blip here is referring to the fact that PPI minus CPI is going up. The wholesale prices are going up more than the consumer prices because the consumer just can't afford it. And factories, the wholesalers know that. Now, interesting, we have a very strong correlation over here. When PPI goes up more than CPI, then certainly the S&P 500 goes up. Maybe that's occurring normally because eventually the costs will be, passed on to the consumer and the producers willing to pay higher prices because they know whatever they pay, they're going to get their money back. But interesting enough, stock market, once again, this weird phenomenon, it's going up even though the other indicator, in this case, PPI minus CPI, is going down. Well, what's going to be the result of this? We don't know. But this is what the Fed is telling us. So, in the next inflationary reports coming out, we're going to pay a very special amount of attention. Does the PPI beat expectations? Does it show more inflation on the wholesale level? How about CPI? And then what's the reflection or the relationship between the two? We're going to come right back to this chart. We want to see if this line blips up even further. Well, that could tell us that the Federal Reserve, through their Beige Book survey, was right. Speaking of the Federal Reserve, we have Boston Federal Reserve President Susan Collins said the central bank should take its time in bringing down inflation. Slow down, but we're going to continue. But warned additional rate hikes could be warranted. In part, she says this phase of our policy cycle requires patience and holistic data assessment while we stay the course. Stay the course meaning, 2% target. They're not going to stop raising interest rates till we hit 2%. They're all saying that. While we may be near or even at the peak for policy rates, further tightening could be warranted. So we may be near the end of interest rate hikes, but maybe not. Further tightening could be warranted depending on the incoming data. Of course, we have to see what the PPI, CPI, what we just spoke about, and many, many other numbers as well. Well, the red circles over here represent the chances that the Federal Reserve will keep rates unchanged at the 525, 550 range. That's at 93%. The meeting's coming up this month, September. 7% chance the Federal Reserve raises interest rates to 550, 575. We could see again, it's interesting, the real turning point. We did have at one point only a 78% chance the Fed was going to keep rates unchanged, a 22% chance they were actually going to raise rates. But all that changed after the Federal Reserve Summit. This is Jackson Hole, Wyoming, and then a lot of other Fed speakers as well. Then we had the Case-Shiller Home Price Index. GDP showed us some slowdown. Non-farm payroll, they revised down 2 prior months. So the data is weak. We went over this, and this last week we did a whole kind of monthly recap. The data lately has been weak except for inflation. What's the Federal Reserve watching? Are they watching the weak GDP numbers, 2.1%? Are they watching the non-farm payrolls that revised June and July down by 110,000 jobs? Or are they watching inflation? And now we know specifically what part of inflation that they're watching from the Beige Book. They told us that PPI is going up more than CPI, that the consumer can't handle it. And by the way, this is very interesting. Let's watch the wholesale inventory numbers. It's coming up pretty soon. The wholesale inventories, it shows us the inventories that these factories and these producers hold. If inventories are very high, that's not good. Imagine we're running a company and there's a lot of inventories in the plant and the factory. That's not good. We want our consumers to be buying all of these inventories. If inventories are very high, it confirms what Susan Collins, Boston Fed president, said. They're having the Fed, or I should say the Fed, the manufacturers are having a hard time passing on the inflated PPI to the CPI. So, that's the wholesale inventories, may give us some insight into that. Very interesting to see how this all plays out into the ultimate Fed decision and then the ensuing market reaction. We hope this has been helpful. We look forward to seeing you back soon.